Good morning, everyone. Thank you for joining our Nedgroup Investments Global Equity Fund update for Q1. During these difficult times, we want to support and equip you to proactively manage your clients' concerns. This telecon will be recorded and the replay will be made available. We have shared the presentation slides with all participants and will refer to these during the call. Alternatively, we have uploaded the slides into Skype. Please note that we will feature a live Q&A during this call. Please type in your questions into the dialog box on your screen. We will endeavor to address as many of these as possible during the last 10 minutes. Topics for today include Q1 performance review, current positioning of the fund, and outlook for the rest of the year. This morning, we have Antony Burgess, Managing Partner at Veritas Asset Management, calling in from London. Good morning, Ant. Thanks very much for joining us.
Thanks, Anil, and hello, everybody. And thanks very much for taking the time to dial in. Very happy to be joining you here, albeit in my boxer shorts somewhere in the middle of in the UK. But you're glad you haven't got the visuals. Right. What I'd like to do is obviously to focus on Q1 and then to more importantly address the outlook looking forward and what we've been doing in the portfolio and how we're addressing the COVID situation. So what I'd like to do is just to turn to slide 2, which just gives you the overview of performance to the end of March. And here you can see the 3 months and 12 months performance against the MSCI World Index, as well as our inflation target. I mean, clearly the inflation target's not going to be met in a sharply falling market, but the fund held up relatively well in the first quarter, and that's helped the numbers for the 12 months. And maybe just to give a step back before we look at Q1, as many of you will know, we're very price disciplined, and coming into 2020, the fund had quite a significant amount of cash, about 14%. And this is not an asset allocation decision. We had no foresight on COVID or markets falling. But what we did find was that when we were selling positions last year, it was becoming increasingly difficult to redeploy that cash. Again, many of you will know that what we do is when we're looking for a company, we're effectively valuing that business in 5 years' time purely based on its cash flow. So what we look for is very predictable businesses, companies like Microsoft, where they're on a subscription model, very, very dependable. 98% of people renew their contracts year in, year out. And it's very easy to predict the cash flow of that company. What you then need to do is get the growth rate right. How quickly is the business going to grow over the next 5 years? That's a much more predictable business than, say, an oil company where we don't know what the oil price is going to be, the demand for oil is falling, and so on. So what we do is we buy Microsoft, we hold it till it gets to its intrinsic price, we sell it, and then we try to buy another predictable business at the right valuation. And if we're unable to do that, then we stay in cash. So what tends to happen is the cash, as some of you have experienced because you've been kind enough to be in the fund for some time, the cash can ebb and flow. And as we'll come on to see, it's now fully invested, having been 14% in cash at the end of the year. So it's becoming increasingly difficult. We were concerned about valuations of markets. We were concerned about a recession of some description, but clearly no insight into COVID. So when if we then turn over to the next slide and look at the attribution for the quarter, I'm only going to look at page 2 briefly because it's a lot of numbers. This just shows you the attribution by sector. So communication services which includes things like Facebook and Alphabet and some of the cable companies. You can see is a big weighting, average weighting of 23%. The total return was down about 14%, and that added had a total effect of 1.6%. So it was positive because it fell less than the market. But I think more interestingly than this is if we look at the actual stocks themselves on the next slide, and this is where the real story is. So if we look at the companies that performed well over the quarter, they really fit into kind of several buckets. The first, unsurprisingly, are those companies that benefit from people being online more. As we've all learnt, as we've seen through Amazon and Netflix, people are forced to stay at home, and so they're turning to the internet. They're buying things online. They're gaming more. They're doing a lot more online, and so this benefits companies like Altice and Charter because they're cable companies. And in America, if you want a fast broadband connection, your only choice is really three companies in most areas, which is Altice, Charter and Comcast, depending on which location you're looking at. And then Alphabet obviously owns YouTube. And so whilst they've suffered a little bit on advertising revenue, there's been still substantial demand on things like via YouTube and the advertising there, and even search. I mean, some of you may know that things like exercise equipment, for example, is in high demand, hugely searched as people are trying to compensate for not being able to go to the gym. And a lot of advertisers have increased advertising if they're in that kind of specialist area. The second bucket is companies that provide critical healthcare coverage. So Baxter International, one of the areas that they exceed in is end-stage renal disease, so kidney failure. And one of the things that people haven't spoken so much about when it comes to COVID is the fact that because it involves respiration and breathing, that 20 to 30% of people in ICUs have to go on to kidney dialysis. It actually attacks the kidneys and other organs, and so the demand for kidney dialysis machines has also increased dramatically since COVID has emerged, and there's actually a shortage in some hospitals. So Baxter are actually working 24 hours a day, 7 days a week to try and provide not just the equipment, but all of the sort of disposable items like the filters and stuff that go with the equipment. Cigna is a insurance company, and in fact they had their results last week, and they've maintained their guidance for the year, one of the few companies to do so. They haven't really been impacted. They work quite a lot in the corporate space, and so because staff have been furloughed, most companies have continued the medical coverage, so they haven't actually been affected. I mean, it is fair to say that there is some risk that if we start to see some unemployment, and obviously that health cover goes with it, that there may be a bit of impact later on. But so far not really affected. And then Cochlear was something we bought. We'll come on to this during the quarter, but it did very, very well after we bought it, so it actually does show up as a contributor. Cochlear provides cochlear implants to the profoundly deaf. So their biggest market is infants. If you're born deaf and you have the operation before the age of 3, you live a normal life as far as hearing is concerned, because if you have the operation later, your brain doesn't adapt as well, and there's still a bit of a speech impediment. And so this is a classic situation where there's only so long you can put the operation off for. These are things that people aren't going to put off forever. So the next quarter may be a bit soft. But it's something that needs to be done. Then we look at consumer staples. Reckitt's is mentioned here, but we could have had Nestle and Unilever. Reckitt's is the most extreme example. Did well during the quarter because it produces most of the cleaning products that people have been stockpiling. So it's very big in hand sanitizers, things like washing powder, and other, as people eating more at home and doing the dishes, they do dishwasher tablets, that type of stuff, as well as home hygiene products. Interestingly, this has probably been the weaker of the three consumer staple companies that we own in the portfolio from a quality point of view, but COVID has actually been a bit of a game changer for them. And it is something that from a relative point of view, might be the source of cash somewhere down the line. As things normalize, there's only so much hand sanitizer and other products that you need. The next bucket is the more sort of defensive industrial area. So if we look at BAE, British Aerospace, they did particularly well from a relative point of view because they don't have much exposure to commercial aerospace. Only about 5% of the business is exposed there. Defence, by its very nature, is defensive in times like this, unless you think there's going to be huge budget cuts to defence. Given that BAE's biggest market is the US, that's unlikely to happen. If anything, they're ratcheting up, especially after we had the Iranian situation. You've still got various other trade wars and wars of words going on. Defence spend isn't really going anywhere, and that helps BAE. They also bought a couple of businesses recently from Raytheon, which we think are very additive to the business. And then Canadian Pacific Railway, as the name suggests, it's one of the two largest railway companies in the US, transporting goods from one side to the other and also into North America. Now, a lot of people expected them to do quite badly because, if trade is softer, then you're getting less goods transported. But they implemented a much more efficient way of transporting. They're transporting a lot of food and healthcare goods, and they've actually weathered the storm very well. Again, they've had their results recently and much better than expected. So we would expect a lot of upside, once things normalise there. And then Intercontinental Exchange, one of the financials. Intercontinental Exchange is the exchange which futures exchange which looks at things like Brent. So I know most of you will be familiar with the turmoil that we've seen on oil markets, particularly WTI, which went negative for a while. Well, that's traded on the Chicago Metal Exchange, whereas Brent oil is traded on the ICE, the Intercontinental Exchange, and it's held up much better. The spreads have been firmer. It's much more international. America, the WTI is really for North American market, landlocked oil, whereas Brent covers the whole of North Sea, and the delivery of the oil is international. It's not just in one location in Cushing, which has run out of room and has caused the volatility. And so more and more professional users of futures looking for hedging are turning to Brent. ICE tends to do very well whichever direction the market's going in, because clearly it's taking a cut on whether it's going up or down. So again, held fairly firm. And then when we look at the negative side, again, the picture is relatively clear that by far the biggest impact on the portfolio from a negative point of view, unsurprisingly, has been the aerospace sector. So, and this is very different to airlines themselves. So just to run through the four companies and what they do, and then just to flesh that out a bit. So AENA is a Spanish company, and it operates airports, and most of the airports in Spain. It has one or two airports outside of Spain, but the majority of them are in Spain. It's 51% owned by the government, so they have got a line of credit direct there. They're in a very strong position from a solvency point of view, but clearly there aren't very many people going through Spanish airports at the moment, and the company makes its money on things like duty-free, landing slots, etc. Airbus builds the planes, so it's a mainframe together with Boeing. It's really a duopoly. It's those two. They're the two main players. And it produces the most successful airplane in the world at the moment, which is the A320, which is the one that you probably fly between, say, Joburg and Cape Town in, with the single aisle. 10.5 year waiting list, but of course concern has been that as airlines get into trouble, they cancel their orders. There's less servicing and parts, and so revenue is affected in the short term. But Raytheon is a company that we bought in January. It's actually a defence. It's a little bit like sort of a cross between Lockheed Martin and British Aerospace. The reason why it was negative is because they've just completed the purchase of a company called United Technologies, which owns Pratt & Whitney, which competes with Safran. It's another aero engine manufacturer, and it's their engine that goes in Boeing at the moment. So that, but we expect there's a lot of room as the business consolidates. The barriers to entry to these businesses is massive. I mean, there are only two big engine providers for those mid-sized planes, which is Safran and Pratt & Whitney. There's only two airframe manufacturers, Airbus and Boeing. And these companies are, unlike the airlines, which are suffering both from cash flow and solvency issues. Are they going to remain in business without being bailed out by governments? These companies are in a very strong solvency position, so it's much more of a cash flow problem rather than a solvency issue. If Airbus doesn't deliver another plane for 2 years, it can survive. Which is very different to British Airways and the company that owns it, and many other airlines, as we've seen with Virgin struggling, and we've had a couple of local airlines here already go bankrupt. So that's Aerospace. We can come back to that. Capita is an outsourcing company. It's in a turnaround position. We sold half the position last year. The reason why it's fallen is that it's quite a people-orientated business, or big chunks of it are, where they do a lot of call centres, a lot of face-to-face businesses, training and so on. And obviously, most of those staff have been furloughed. But 50% of the business is government related, and in fact they've just won a mandate or extended mandate for the teachers' pension scheme, so they do things like pensions administration. And so, again, from a solvency point of view, they're fine, but they'll probably remain very volatile. But it is something that we're likely to trade out of the portfolio over time. And then lastly, there's one or two companies here that were hit in the short term, even though they're healthcare, just because people were concerned that they were, in the case of Dentsply Sirona, it's dental, less critical maybe than something like Baxter. Becton Dickinson, we actually bought, as I'll come on to in a minute, during the quarter and during the falls, but it's done well since, so I'll come back to that one. Sonic Healthcare does things like diagnostic testing. And again, what they did is they said, look, we just don't know how 2020 is going to pan out. We're going to be affected in the short term, so we're withdrawing our guidance for the rest of the year, and that sort of spooked the market, and we ended up buying some more. The reason Amazon and Microsoft are in brackets is just because of an underweight position. We actually tried to buy Amazon in Q1, and we ended up with about 8 shares for each client's portfolio. And in fact, we've recently sold those into strength because they did extremely well, but we just couldn't buy a full position. The stock took off too quickly. And Microsoft is shown because we were selling it. It's now sold out of the portfolio, and so we had an underweight position in a stock that held up relatively well in Q1. So They were both positive, but they are underweights and therefore show as relative underperformance. So in short, it's a very kind of clear story, which is that anything to do with being online or being able to be online has done well. Critical healthcare has held up well, and consumer staples, so anything with cleaning products, that type of thing, held up relatively well. And then on the negative side, the biggest area of negativity from a relative point of view is aerospace related, probably unsurprisingly. So if we then turn over to into the next slide, this just explains our response to COVID. So clearly this clicked in sort of back end of January. As we went into February, it became obvious that this wasn't just a Chinese problem. And so the way we approached it is summarized on page 5. So stage 1 was really to say, what is the base case, and what's the bear case, what's the negative case. So the base case simply was that the rest of the world is going to follow China, which is that after, depending on the area, 45 to 60 days of lockdown, there's a slow return to normal. We're starting to see this in Spain and Italy now, and we'll see how that works out. But slowly the world gets back to normal, and the second half of 2020 is a slow recovery, and then we get back to a more normalized recovery in 2021. The more negative scenario is that things don't get back to normal. We get second waves. We then have to have intermittent lockdowns, and that this year is a bit of a write-off, and we don't start to get a recovery till next year. It will be slower because of the economic impacts of being in lockdown for longer, and it's not till 2022 that we get a more significant recovery. So what we then did is worked out the rate of return that we would want from any company for both scenarios. As I mentioned at the beginning, we're valuing future cash flows. So we look for the really, there's predictable businesses, and then we try to value them based on our assumptions for the base case, and then we value them for the assumptions on the bear case. We then split the universe list of companies that we have, which is about 250 companies, into 2 lists. The most impacted list from COVID and the least impacted list. And so if we take something, so these are just examples on the right-hand side of this slide, not enough room to put them all down, but if we look at something like the most impacted list, what you can see there is examples of companies which are more geared towards being affected by COVID. So to pick the 3 or 4 obvious examples, companies that we like Amadeus IT. So Amadeus is a Spanish IT company, but it's responsible for the search, pricing, booking, ticketing, real-time sort of processing services for the travel industry. So they also provide software that sort of automates processes such as reservations, and so the customers are going to be airlines, airports, travel agencies, and so on. Travel Sky Tech is similar, but for China. It's a Chinese company listed in Hong Kong, and it's the most dominant provider of IT solutions for China's air travel. Travel in China is growing quicker than anywhere else in the world. Twice as many people applied for passports last year, and they're probably going to be the first to get back to normal, albeit within the region as opposed to maybe international. And then some of you will probably be familiar with Booking.com, very similar again, but more focused on, it operates sort of travel fare meta search engines, things like Priceline and Booking.com, cheapflights.com, that many of us go on to when we're trying to look for a cheaper holiday. Vale Resorts is a ski resort. Well Tower is effectively old people's homes in very well-off areas, and so on. So these are areas that are much more impacted, become exceptionally cheap, And so we had an IRR for both the base and the bear case. And then you've got the least impacted. So if you like, sort of better quality for the environment that we're in at the moment. And here, you've got more examples of companies that are benefiting from either the sort of online thing, lots of healthcare type companies that are offering critical solutions and products. Companies like Varian, Cochlear that I've mentioned, Becton, Abbott Labs will come on to, and CSL, which is blood products. And then you've got MasterCard and Visa, which clearly are responsible for payment systems online as well as offline. And then another consumer staple company in Diageo. So what we did is we basically arranged the universe as you see here. And we had a buy price for the base case and the bear case. And what we did is we initiated a position in the names that we wanted to buy of about 1% when it got to the base case IRR. And then we increased the weighting when the markets fell further and we got to valuations that really were discounting our bear case. And because of the magnitude of the fall in March, we were able to stick to the stocks on the least impacted list, which was our preferred list, because clearly you've got a hedge against this thing getting a lot worse by not buying the ones on the most impacted list. So if we turn over, you'll see on the next slide the companies that we bought and sold. So forgetting Raytheon, which we bought in January, so this was really before it kicked off. The companies that we bought were Abbott's, Alibaba, tried to buy Amazon, as I explained, but weren't very successful, Beckett, Cochlear, and MasterCard. So in the interest of time, I won't go through all of them. And there's certainly a couple of slides on Abbott Labs, which I won't go through in detail, but just to explain what it does, and you'll get a flavour as to why this was a great opportunity to buy something that we didn't think we'd be able to buy at the valuations that we ended up buying it at. So Abbott Labs is a healthcare company that operates in sort of three main areas that could be game changers for the business. The first is diabetes. So it produces a gadget called Freestyle, which it basically monitors the blood sugar level of diabetics. So rather than having to prick your finger once or twice a day to measure your glucose levels, this unit, which is almost the sort of size of a coin, sort of like a medium-sized coin, you stick it to your arm and it just continuously monitors the glucose levels. And so the diabetic has less kind of glycemic events, and it's much more, and it's a very sort of cheap unit for them to own. So very, very huge market for diabetics. There are about 430 million diabetics globally, and that's expected to double by 2050. And there's only 2 million patients using the product today, and they reckon that they can get to sort of 2/3 of users over time. So there's a massive runway for this particular product. The second is that they do artificial heart products. And heart disease is still the biggest killer in the world, and most heart operations have been put on hold and are actually only slowly getting back to normal. There's only so long that you can put these things off for, and they provide some of the biggest in-demand products for things like artificial valves. And then the last area which is the most topical, is their diagnostics. So Abbott Labs has rather fortuitously, for us having just bought it, about 3 days afterwards announced that they've come up with the quickest COVID test, which is being rolled out in the States, where you get the answer within 5 minutes of taking the sample. So as you can tell, pretty critical services and products that they provide, and it just fell with the panic that we saw in Q1. Just to stick very quickly with the other healthcare companies, Cochlear, I think I've already mentioned, it's got a massive emerging market potential as well, because places like China have just approved to have reimbursements for this operation over there for particular infants. And then Becton also provides critical products for hospitals. In fact, it's actually the world's biggest producer of plastic molded parts, because it has it produces about 40 billion medical devices a year that are used in just about every part of the hospital, things from syringes, needles, etc. And they also do pumps. So when you're looking to pump nutrients into a patient or something similar, oxygen, etc., a lot of their pumps are being used. And then Alibaba, a little bit like Amazon, but the Chinese equivalent. We think online is going to become increasingly important. There are more people buying things like fresh produce online, which was an area that wasn't growing for Alibaba, and now that's picking up. They're also investing a lot of money into cloud, given what they've learned since COVID. And then MasterCard, something that's been on the universe list for a long time. We haven't been able to buy it. People have got worried that they do a lot of travel-related payments, and so that's been affected. But it's been, in the short term, compensated for by the online purchasing. I mean, if you use PayPal or any other online payment system, it's Visa and MasterCard's processing that is working in the background, and so they do well in that environment. I mean, just to illustrate the point, MasterCard was trading at $350 prior to the COVID outbreak. It fell to $240. We bought 1%. That was our base case scenario. It then collapsed further to actually $199, just literally under $200, and then we bought the other 2% position to bring it up to 3%, an average price of around sort of 220-ish. It's currently standing at about 270. So that's what we tried to do during that quarter. And then on the right-hand side, we sold those three businesses that you can see in the first quarter. Dentsply actually to buy Cochlear, because we were fully invested at that time. So we sold one healthcare company to buy a better one. Already been sold in January, and likewise Rolls-Royce. So maybe flicking the next couple of pages, just tell you a bit more on Abbott, which I won't go through. Just to finish on the portfolio breakdown on slide 9. This shows you the position of the portfolio at the end of March. So you can see 30 stocks in the portfolio, the top 10 listed on the left-hand side. So you can see there are actually no aerospace companies in there. So even though we have bought a little bit more Safran during the weakness, we've actually bought and increased holdings in much more kind of predictable, visible businesses for the next 5 years, whilst we had the opportunity to do so. So you can see cash next to zero, 0.5% of cash. That's the first time since the financial crisis. The last time we were fully invested was in 2008, after the financial crisis. This has been a similar opportunity as far as valuations are concerned. I mean, there is a very good chance that we've already seen the bottom of this market. You can see the regional and the sector weights on the right-hand side. Again, that's just an outcome of the stocks that we're buying. So I wouldn't read too much into that, but from a sector point of view, I suppose it is quite interesting that we're back up to the sort of maximum that we allow ourselves, which is 30% in healthcare. Communication services is those internet businesses like Alibaba, Alphabet, Facebook, and the cable companies, and then industrials is largely aerospace and defence. So they're the biggest positions, and then consumer staples. So we are last thing, and then I'll open for questions. I mean, one of the things that we did going into this, which I guess has helped, is that because we were concerned about valuations in a possible recession, we did a lot of work on solvency of every position in the portfolio. And what I mean by that is, the sort of term of the debt, the covenants in place, how much cash they generate, would they be able to survive if we go into a recession and it was difficult to, renew their debt unless they could do it themselves. So we did a lot of that work, and whilst clearly we're now being tested with a very extreme event as far as solvency is concerned, I think it has, it stood us in relatively in a good position, and we're very happy with the stocks that are present in the portfolio today. So with that, I'll stop and see if there are any questions. Thank you.
Thanks very much, Ed. So we only have time for one question, and the question is around Charter Communications, which is your top holding and has also done very well this year to date. Just what's your comfort levels around continuing to hold the stock?
Yeah, no, so it's a very good question, and actually rather timely. They had their results at the end of last week, and the thesis continues to play out very well. So Charter, we bought it because of the broadband story, as more people tune into Netflix, YouTube, etc. And the recent results have shown that they've picked up more broadband customers than expected, and they're losing less cable company customers than expected, because that's their historical business. It doesn't generate a lot of money, but so it's a very good question, because it's not as cheap today as clearly it has been. And if we've got a price, I think, of close to 600 on it, it's not a million miles away. So as we approach that value, you may well see it be trimmed back. On a valuation basis, by far the cheaper of the two, because it's a bit more leveraged. Although, if you're generating lots of cash, leverage can be a positive. If you're in a business that everybody wants and you're still generating lots of cash flow, then that's not necessarily a negative position to be in. I think the other thing to bear in mind with Charter is that it's buying back a lot of its shares, so it's increasing value by buying and cancelling shares. And in fact, they bought twice as many as people expected in Q1. Whilst the valuations had been hit, so the management is pretty shrewd. I mean, you are looking at a CEO chairman that is a founder of the business. He's got a lot of skin in the game. Very, very well run business, but we do have to be price disciplined. So there will be its price at which you'll see that holding be trimmed back and eventually sadly sold at some point.
And sorry, I know we said just one question, but I guess another one that was quite interesting that came up was just in terms of your sector weighting to financials, which they've taken quite a big hit over the last couple of months. And just, are you guys finding any good value, any good opportunities there to take advantage of?
Yeah, sorry, the line cracked when you mentioned which sector. Was that industrials?
Financials, which have taken a bit of a hit recently. Are you finding any opportunities there?
Well, I suppose only in the sense that we've bought MasterCard. So we don't particularly like banks. We did add to the one bank that we do own in the fund for you is Svenska, which is the Swedish bank. It's definitely the best quality bank in the world as far as we're concerned. It's got the highest return on capital of any European bank. Very different business model. So we did use that as an opportunity to add. I mean, to give you an example, Svenska because of the furloughing of staff in some areas, they've been mandated to cancel the dividend. You know, it's very easy for them to pay the dividend, but for political reasons, there are some companies that, you know, can't pay their dividend. You know, BAE is another one. You know, very, very strong position, but it smacks, it just looks poor from a sort of political point of view. So we won't be rushing into banks. The sort of things that we like are the exchanges, the sort of stock exchanges, the payment systems. We like fintech, so the financial technology, software type providers. So yeah, there are a number of those things on the universe list, and the next kind of wave of buying, I guess, that there could be opportunities in that space, but it's very unlikely unless it's an Asian bank. You know, there are one or two Asian banks like HDFC in India that we like, much better quality than any European bank. Those are the sorts of things that we might venture into, but it won't be any other sort of European or US bank.
And Ant, maybe just a bit of a more philosophical question around share buybacks. And obviously there's quite a significant incentive for current management where they benefit quite a lot from doing those types of actions in the open market. Just what are your thoughts around that?
Yeah, I mean, it's an interesting one because share buybacks is quite as you know, is much more common in the US than paying dividends, or certainly that's been the case historically. Although some companies have started to pay increasing dividends. I mean, Microsoft was one of the first to do it within the tech space, whereas you know, Alphabet, you know, you get next to nothing. It really depends on what's on a case-by-case basis. You know, if a company is buying their shares on what they think is a very low valuation and cancelling the stock, then that's actually you know, quite a good use of cash. If they could deploy the cash by buying a business and making a much higher return on that cash, then that's a better option. But we would rather they buy the shares than buy something that makes no sense and isn't going to add to shareholder return. Of course, the question really comes down to, if you're generating lots of cash and there isn't anything to buy, from a kind of merger point of view, why not give it back to shareholders? So in some cases we will lobby companies to pay a special dividend or increase their dividend if they really haven't got anything else that they can do with it. I mean, you have to look at other things like where the cash is sitting and the tax if they repatriate it and all that type of stuff as well. So it has to be done on a case-by-case basis.
Thanks very much, Ed. So just apologies for some of the background noise here, but we appreciate that it's a public holiday there in the UK. So thanks very much for calling in and for your insight and expertise.
Yeah, pleasure. Thanks. Actually, the holiday was shifted to Friday, so it's in our calendars as today, but it's actually Friday. So don't worry, it's actually a normal day today.
Okay, great. But we appreciate your insights in any case just as much. To our valued investors, please feel welcome to contact us if you have any additional questions or queries that you may have. Your trust is important to us, and rest assured that we are available to support you and your clients during these difficult times. Otherwise, thanks very much for joining us today. A reminder that we will be speaking to Brian Salmo for an update on the Nedgroup Investments Global Flexible Fund tomorrow. Given the time zone difference to Los Angeles, just please note that the call will take place at 4 p.m. tomorrow afternoon. Best wishes for the rest of the day. We look forward to connecting with you again soon. Take care.
Thanks, everybody.